Good morning, ladies and gentlemen. This is Chris Cook with BackNine Insurance. Today's webinar will be hosted by Dave Weber with Mutual of Omaha. Our subject today will be Guaranteed Universal Life with Value and Flexibility. You will be muted during the webinar, so any questions that you may have, we will follow up with you at the conclusion. And with no further ado, here is Dave Weber.
Thank you, Chris. Appreciate it. Good morning, everybody. My name is Dave Weber. I'm the Life Sales Director here at Mutual of Omaha. And, of course, I work closely with all the folks there at BackNine and appreciate the opportunity to talk with you guys today. I want to spend some time today talking about our GUL product with Mutual of Omaha and the flexibility and the value that our product provides versus other products in the market today. I'm sure most of you know that the primary advantage of a guaranteed universal life policy is that you're able to offer your client the highest death benefit at the least amount of premium. But there are some disadvantages as well with a guaranteed universal life product, and probably the biggest is that it provides little to no cash value, which means that there's little to no flexibility and little to no options for your customer in the future. United of Omaha right now is the only carrier in the industry that offers a full refund of premium on a guaranteed universal life product after years 20 and 25, so we are unique in the market right now. So today I want to share a few ideas with you that illustrate the flexibility that your client will have with the product in the future that they would not ordinarily have with a traditional guaranteed universal life policy. Okay, so let's start with, what I want to start with is the living benefits that are provided by this product. We have a built-in accelerated death benefit rider for terminal illness, which means on every guaranteed universal life policy that we issue, the insured is able to access up to $1 million or 80% of their death benefit, whichever is less for a terminal illness. The client only has to provide evidence that their life expectancy is 12 months or less, and it's, as I mentioned, built into every policy. We also have built into every guaranteed universal life policy a accidental death benefit rider for chronic illness. I will mention that this product is not, or this particular feature is not yet approved in California or Connecticut, but for those of you who are doing business outside of California, the insured can access up to $1 million or 80% of their death benefit if they are meeting 2 of the 6 ADLs or have a severe cognitive impairment. They can access any amount of money up to the IRS per diem of $120,000 per year. So in effect, each and every year, if they are still meeting 2 of those 6 ADLs, they can access up to $120,000 each and every year. What are the underwriting requirements and application requirements for that particular benefit, the chronic illness rider? There are none. As I mentioned, it's built into every policy. If we issue a guaranteed universal life policy, whether it's Table 2, Table 4, Table 16, or Standard, they will have the built-in guaranteed chronic illness rider built into the policy. Let me give you an example of actually how that works. So we've got an insured, has a $500,000 death benefit. So in that case, since they can only access up to 80%, they can access up to $400,000 of their death benefit if they are meeting 2 of 6 ADLs or have a severe chronic impairment. So the insured can access any dollar amount, as I said, that they would like. They can take $10,000, they can take $50,000, they can take $100,000, anything up to the IRS per diem of $120,000. So in this example, the insured has decided to take $100,000 of their death benefit. At that point, we apply an actuarial discount. And what we do, it's all based 100% on their life expectancy. So what we do when they are meeting 2 of the 6 ADLs, we get their medical records and determine what their life expectancy is. In this particular example, their life expectancy is 3 years. So we multiply that 3 years times the actuarial discount of 13.5% or 4.5%. which gives us a discount of 13.5%. So they've requested $100,000. We deduct the actuarial discount of $13,500, and for each year that they exercise this benefit, we also charge $100. So that leaves them with a check that we will send them for $86,400, and they can do whatever they want with that money. It's an indemnity, so we need no receipts or anything like that. So in this particular example, Bob's wife was able to take a leave of absence from work and care for his wife for $64,000. And they were also able to use the rest of the money to take a luxury vacation to Hawaii for $22,000. So now what we do is we deduct the amount that they actually requested, which in this case was $100,000, which would now leave them with a remaining accelerated death benefit amount of $300,000. So now they have a $400,000 death benefit, and they can access up to $300,000 of that next year. Okay. This product, as I mentioned earlier, also provides liquidity needs with what we call the guaranteed refund option. The insured can access up to 50% of their premiums, actually surrender the policy and get 50% of their premiums back in year 15, and get a full 100% of their premiums back in years 20 and 25. Again, we're the only carrier now that does offer a full 100% of return of premium in years 20 and 25. There's no cost at issue or election to this particular benefit. It's built into the policy. Now, there are some restrictions on the guaranteed refund option. The maximum benefit is capped at 35% of the face amount. So in other words, if they have $1 million death benefit and over 20, 25 years they've paid in $400,000 in premiums, the most that they could get back would be $350,000. We cap it at 35%. The policy must also maintain a minimum dial equivalent, or in other words, it must be guaranteed to age 100. So if they're missing, if they originally took out the policy to be guaranteed to age 100 and they've missed a premium, they'll need to reinstate or add another premium to get that reinstate that premium, guaranteed premium, back to age 100. There are also some restrictions in terms of whether or not the insured is rated or if they're a smoker. So if your client is under age 50 and they are rated anywhere from table 1 to 16, if they're rated at all, they will not get the return of premium feature, the guaranteed refund option. Also, if they're a smoker and under age 50, they will not get the guaranteed refund option. If they're over age 50 and they're a smoker, that's okay. They will still get the guaranteed refund option even if they're a smoker over age 50. But if they are rated table 5 to 16, they would not get the guaranteed refund option. So to put that in easier terms to understand, we looked back at all the GUL cases that we placed since 2012, and 94% of those cases would have gotten the guaranteed refund option. Okay. You'll be able to tell whether or not your client is eligible for the guaranteed refund option on the illustration that you give them, because it will show in the ledger exactly what they'll get back in the 15th, 20th, and 25th year if they surrender their policy. Okay. So I want to share some ideas that just illustrate the flexibility of this product with the guaranteed refund option. We've got a female, Barb. She's age 54. She's a standard non-tobacco risk, and she needs $1 million of death benefit coverage with a lifetime guarantee to age 120. The premium for that for United of Omaha would be $10,924 a year. Now, she does have the option, obviously, to purchase a traditional guaranteed universal life policy. But in that case, as I mentioned, she's going to have little to no cash value, which means she'll have no liquidity and no flexibility in the future. So she makes the wise decision of purchasing a guaranteed universal life policy with United of Omaha. As I mentioned, that premium would be right around $11,000 a year. She has a guaranteed death benefit to age 120, and she has the option of getting 100% of her premium back in years 20 and 25 if she surrenders the policy. And during that entire period of time, she also has access to up to $800,000 of her death benefit if she contracts a qualifying chronic illness. So let's fast forward now 20 years. Barb's now 74 years old. She's retired. Her investments are doing okay, and she's living relatively comfortably on that retirement income. But the problem is she's got a daughter and a son-in-law and 2 grandchildren that live in Europe, and she'd like to visit them at least once a year for a couple weeks, 2, 3, 4 weeks. As I mentioned, her investments are doing good, but she's got very little disposable income, so she really doesn't have the money to travel. So what options does she have? Well, she's got the guaranteed refund option, or the guaranteed universal life policy with United of Omaha. So since she's retired now, all of her kids are gone, she really doesn't have a need any longer for the full $1 million of death benefit. So she makes the decision to take a reduced paid-up policy for $660,000, which is paid up to age 120. She's now saved herself $11,000 a year in premium payment. She never has to make another premium payment again, and she's got $660,000 of coverage. She now has $11,000 a year to travel to Europe to see her family. Okay? During that entire period of time, even though she's reduced her death benefit to $660,000, which is paid up to age 120, she still has access to $528,000 of her death benefit if she contracts a qualifying chronic illness. So now let's fast forward 5 more years. Barb's now almost 80. She's decided that she's done traveling, and in the last couple years her investments have taken a downturn, and she's a little bit concerned whether or not her money's going to last till the end of her life. And at this point she really has little need for life insurance coverage at all. So what are her options now? So Barb still has that guaranteed universal life policy, that she's the reduced paid up policy. In year 25, after year 25, she decides she's going to surrender that policy, and she's going to get back $218,000. That's the amount of premiums that she paid during the first 20 years. She's going to use that money to purchase a $25,000 to $50,000 final expense policy, a single premium, and use the remaining funds to supplement her retirement income. That's something that she could not have done with a traditional guaranteed universal life policy. All right, here's another idea. If you've never thought about splitting a guaranteed universal life policy into 2 policies, that's what I want to talk about right now. We've got Ben, who is age 45, standard non-tobacco risk. He needs $5 million of death benefit coverage, and he wants it guaranteed to age 100. The premium for that policy would be a little over $43,000 a year. The first option, obviously, is to buy one policy for $5 million, cost $43,000 a year. You can see how much it would cost him to pay that up to 100, and you can see what his return of premium would be if he decides to cancel the policy in year 15, 20, and 25. But what about option 2? Ben's advisor tells him, what about we split the policy from $5 million to a $3 million policy and a $2 million policy. In that case, he's paying exactly the same premium, $43,000 a year, exactly the same up to age 100, and if he decided to cash in both policies, he would get back exactly the same amount as if he had one policy. So what is the advantage of splitting into 2? He could actually take that $2 million policy, decide to surrender it, and use the money that he gets from that surrender to pay up the $3 million policy all the way to age 120. So what he's done now is he has $3 million of coverage, and he saved himself $43,000 a year in premium payments. He never has to pay another premium again. Another option that he would have at age 65, 20 years down the road, is he could actually cash in the $2 million policy and use that money to buy, buy a paid-up long-term care policy. By a paid-up standalone long-term care policy, because at age 65, his need for long-term care is more than it is for a $2 million life insurance policy. So again, it just gives him options that he would not otherwise have if he only had one $5 million policy. This just shows the ledger of his $3 million policy. You can see that he's paying $25,000 a year for the first 20 years. In the 21st year, he takes the money from the $2 million policy, $326,000, puts it into the $3 million policy, and you can see that it's paid up through age 85, through age 100, and it's guaranteed all the way to age 120. So the amount that he got back from the $2 million policy, the 100% refund was $344,000. The premium necessary to pay up the $3 million policy was $326,000, and he has an extra $18,000 in his pocket that he can do with whatever he wants, and he never has another premium payment again and has $3 million in life insurance coverage. One other idea that I wanted to share here, if I can pull that up, is the what ifs that your clients have when purchasing a guaranteed universal life policy. What if the client no longer needs the policy up here at the top? Well, with the United of Omaha policy, they can get a 50% refund in year 15, 100% refund in years 20 and 25. What if the client missed a premium 1 year and then resumed the original payment? How would that affect the guarantee? Well, if the client missed the payment in year 4 and resumed payments after that, their guarantee would still run to age 96. Age 6 would, or in the 6th year, would still run to age 96. If they missed a premium in year 12, the guarantee would still run to age 100, and you can see how far it would run in the later years as well. So even if they miss a premium with this product, their guarantees still last probably for their lifetime. So what if the client wanted to restore the guarantee back to age 120 after missing a payment? The catch-up provision. So if they missed a premium in year 4, their premiums for the rest of the period to age 120 would be $13,000 versus the $12,142 that they had been paying. So if you take a look at this versus other guaranteed universal life products, the catch-up provision is very reasonable with United of Omaha. What if the client reduced the face amount and stopped making payments but wanted to keep the guaranteed age 120? As in the first example that I gave, if they want to reduce paid-up policy, this particular person is age 55. In year 15, they're age 70. They can get a reduced paid-up policy for $550,000 and save themselves $12,000 in premium. And you can see in years 20 and 25, the reduced paid-up amount is even higher, and they can save themselves, again, $12,000 a year in premium and still have a very healthy death benefit. So what if the client didn't think they would need the full death benefit later in life? Again, this is an example of splitting the policy into two. This particular example is a $1 million policy that we're splitting into two $500,000 policies. And you can see here that the premium is going to be a little bit higher because of the banding, the cost of insurance. You're paying $12,550 versus one policy would be $12,142. So they're paying about $400 more a year. But having two policies gives them, again, the flexibility that they otherwise would not have. This particular person in year 15 could decide that they no longer need $1 million of coverage. They only need $500,000. So in year 15, they can cash in one of the $500,000 policies, get 50% of their premium back, which is $47,063, and the guarantee would run all the way to age 93. So they'd have a paid-up policy of $500,000, no more premium payments, and the guarantee on that $500,000 policy would go to age 93. Okay? Now, if they decide in year 20 that they no longer need $1 million of coverage, they only need $500,000. Again, they could cash in one of the policies, get $125,000 back, use that $125,000 to pay off the other $500,000 policy all the way to age 120, and have $55,000 left in their pocket that they can use however they want. Even more drastic in year 25, this person would be age 80, or actually age 90 at that point. Again, they only have a need for $500,000. They cash in one policy, get $156,000, and use $65,000 of that to pay up their existing $500,000 policy to age 120. and have $91,000 to help supplement retirement or use however they wish. This is a piece that we will go ahead and send out to everybody that's on the call. It's a very good piece that illustrates the flexibility of the guaranteed universal life when you split the policy and use that guaranteed refund option. It's something that you could probably use this week with your client. Okay, so sorry, I'm trying to get back. Oh, okay, here we go. All right, so in conclusion, I just want to again reiterate the flexibility of the guaranteed universal life policy with United of Omaha. It provides protection for dying too soon, for living too long with the guaranteed refund option rider, and for getting sick along the way with the chronic illness rider. So I hope it's a product that you will consider recommending to your clients. And I appreciate you guys getting on the call today. And happy selling and have a good week. Thank you very much.
Dave, thank you so much for taking the time. Mutual of Omaha, United of Omaha is a valued partner of BackNine, and we have seen much success with this product and the flexibility of the riders. Today, I will be reaching out to you with an email of the presentation and all the supporting documents. My name is Chris Cook. I can be reached at chris@BackNine INS. That's BACK, the number 9INS.com. And my direct phone number is area code 805-413-0286 for any immediate questions that you may have or illustration requests as well. Thank you, and we will be in contact.